Everyone, thanks for joining us for today's webinar. This is Eric from HR Simple, and today we're talking about the Affordable Care Act, a law which needs no introduction for HR professionals. We're pleased to welcome back today's presenter, Teresa Teare from Shawe, Rosenthal. Their firm authors the Maryland Human Resources Manual and model policies and forms for Maryland employers on hrsimple.com. Today's presentation will last approximately 60 minutes with some extra time for Q&A at the end. hrsimple.com is an HRCI approved provider and Assurant preferred provider. At the end of this webinar, we'll give you codes for both certifications to get your credit. Please enter your questions in the chat box. Teresa is going to go through them at the end. She has a lot of good stuff to get through today, so yeah, we'll get to all of your questions as much as we can at the end. A recording and slides will be emailed to all registered attendees after this presentation. We're also posting all of our webinars at youtube.com/HRSimple. Okay, so a little background info on our speaker, Teresa Teare. Teresa Teare is a partner at Shawe Rosenthal who represents employers and management in labor and employment-related litigation. She regularly represents clients from a broad range of industries, including nonprofits, educational institutions, and insurance companies throughout the federal, state, and local court system and before administrative agencies. Teresa advises clients in virtually every facet of employment law, including implementation of policies, recruitment and selection of employees, hiring procedures, wage and hour compliance, counseling and disciplinary actions, Family and Medical Leave Act management, disability accommodations, performance evaluation and review process, investigations resulting from the allegations of harassment, and termination of the employment relationship, including mass layoffs. Teresa also provides guidance to employers on their obligations under the Affordable Care Act. Teresa regularly provides training to management and employees on a variety of issues, including compliance with anti-discrimination and anti-harassment laws, the Family and Medical Leave Act, the Americans with Disabilities Act, and the Affordable Care Act. Active in the American and Maryland State Bar Associations, Teresa has been an adjunct professor at the University of Baltimore School of Law, where she taught courses in legal writing and advocacy. So we got a great topic. We got a great speaker today. And I'm going to go ahead and turn it over to Teresa.
Thank you so much, Eric. Good afternoon, everyone. I am pleased that you could join us today to discuss the reporting obligations under the Affordable Care Act. Eric, thank you for briefly introducing me. And I'm just going to say a little bit about my law firm. Shawe Rosenthal. We are a labor and employment boutique firm who represents management only. We have a nationwide practice. We're ranked continuously as a first-tier law firm by Chambers USA and have top ratings by Martindale, College of Labor and Employment Lawyers, and the best lawyers in America. We represent employers throughout the United States in federal and state courts before the EEOC, NLRB, and other administrative agencies, and in arbitrations. Our clients range from Fortune 100 companies to smaller businesses and nonprofits in a wide range of industries. As you probably know, the new year will bring new compliance responsibilities for human resources personnel under the Affordable Care Act. Today, we are going to discuss the Affordable Care Act's shared responsibility requirements and the upcoming information reporting obligations for employers. We're going to review the IRS Forms 1094-C and 1095-C in detail, and you may have looked them over or you may be familiar with them already, but we're going to look at them in detail so that we can go through what is required to be reported to the IRS and to employees in this upcoming year. As Eric mentioned, I hope to field questions at the end, if time permits, as I think it will. You can type in your questions along the way, and I'll go through them at the end. So the Affordable Care Act was passed in 2010, so over now almost 6 years ago. But employers are slowly but surely coming to appreciate the complexity and burdens that it imposes. It can cause a lot of anxiety for HR personnel, and in fact, I am getting more and more calls. I'd say 25% of my calls each week are about the Affordable Care Act and the obligations for employers under the law. By way of background, and to put into context the reporting requirements, I'm going to give an overview of the shared responsibility provisions of the Affordable Care Act. Because without these basic building blocks, when I start to talk about the forms and the reporting requirements, it might not be understood by many of the audience members. Although many of you might know about the Affordable Care Act, I find that even my most sophisticated clients still have trouble understanding, well, what's minimum value, what's minimum essential coverage, what's affordable, and what employers have to comply. Who does the law apply to now? Do small employers have to report for this year? So I'm going to go over some of the basics and walk you through these key terms. So as you might know, under the Affordable Care Act, employer shared responsibility provisions, commonly referred to as the pay-or-play penalties or provisions, applicable large employers, often called ALEs, must offer minimum essential coverage that is affordable, that provides minimum value to substantially all of their full-time employees and dependents, or potentially make an employer shared responsibility payment to the IRS. So you either provide minimum value, minimum essential coverage that's affordable to your full-time employees or dependents, or pay a penalty. And I emphasize these words because you're going to see them over and over, and we're going to go through what they actually mean. So, applicable large employer. Most people know that large employers under the Affordable Care Act, or those that might face penalties if they don't provide health insurance coverage to their employees, are those employers with 50 or more full-time or full-time equivalent employees. I want to point out that employees are counted at the control group level. That means if there's a common ownership amongst businesses or entities, or even government entities, they're going to be aggregated so that that employer might be an applicable large employer under the Affordable Care Act. The penalties, however, I want to point out, apply to the applicable large employer member. So there's two different definitions here. You have the applicable large employer that can be aggregated amongst different entities to reach the threshold of 50 employees. And then you have the members, so the actual entities that make up that applicable large employer. And that member is going to be who's doing the reporting. The member reports, and the member is subject to penalties. Okay? So 50 full-time or full-time employee equivalents during the preceding calendar year. So you should have measured during 2014 calendar year to determine if you're a full-time, if you are an applicable large employer for 2015. Full-time employees are those working 30 or more hours a week. Any employee who works on average at least 30 or more hours a week is considered a full-time employee. Employers can still define full-time employment for other purposes differently, using this standard 40-hour work week or 35 or 32 for other purposes. But for purposes of the Affordable Care Act, determining who you have to offer coverage to, you have to define those full-time employees as those working 30 or more hours a week. Now, what does affordable coverage mean? You have to offer coverage that's affordable. Employer-sponsored coverage must cost no more than 9.5% of household income to be considered affordable. And Under the Affordable Care Act, as it was written, the affordability standard was based on the household income, as this slide highlights. But how do you determine what your employee's household income is? You can't. It's virtually impossible unless you ask employees how much their spouse makes or how much, their son who lives with them makes. It's impossible for employers to know that. So the IRS came up with 3 safe harbors, which is based on looking at the employee-only offer of coverage. So since there's no practical way to know what an employee's household income might be, employers can use one of the 3 safe harbor methods identified on the slide. You can look at the employees, if the single coverage is less than 9.5% of the employee's W-2 taxable wages, or if single coverage is less than 9.5% of the employee's rate of pay, or if single coverage is less than 9.5% of the federal poverty level for a calendar year. The test is for employee-only coverage and not based on family coverage. In order not to be subject to penalties, the employer must also provide coverage that meets minimum value, a minimum value of 60% under the law. And an employer-sponsored plan meets minimum value if the total claims paid by the plan divided by the total claims paid by the plan plus deductibles and copays and co-insurance paid by the members exceeds 60%. So the government is interested in making sure that the health insurance plan is paying out most of, or more than a majority of, or 60% or more of the money it brings in back to benefits. And that makes up the actuarial value of a plan. And you'll take some solace in learning that most plans, the government has come out and said that most plans meet this value. In order to determine whether your plan meets that value, there is a calculator that the government has come up with. The HHS has prepared a calculator that you can go online and figure out if your plan meets minimum value. In addition, you have to offer coverage, so an employer has to offer coverage that meets the minimum value, that's affordable, to substantially all of its full-time employees. What does substantially all mean? It means to at least 95% of full-time employees and their dependents. Otherwise, the employer may owe an employer shared responsibility payment, the category A penalty, which is the bigger penalty, if you don't offer it to substantially all. Now, I want to point out that for 2015, so for this tax year, that threshold has been lowered to 70%. So for 2015, so long as you've offered to 70% of your full-time employees, you won't be subject to that higher penalty. However, even if you offer to 70%, and one of those employees who's not in the 70% goes onto the exchange, gets a tax premium or tax credit for their health insurance, the government can still penalize the employer, but it's the lesser penalty. It's the lesser penalty, and it's only based on that one employee who's gone out onto the exchange. So talking about penalties, what are the penalties? Here's a flow chart that might make it clearer for you to understand if you might have a good understanding of it, but I want to walk through. So, based on our conversation and in my discussion, do you offer coverage to at least 95%? For 2015, it's going to be 70%. If you don't offer to substantially all, then you could be subject to a penalty of $2,000 per full-time employee minus the first 30. Again, there's a caveat here. In 2015, it's minus the first 80. And it only applies if one or more full-time employees receives premium assistance for exchange coverage. So it's only triggered if the government figures out that someone in your employment has gotten premium assistance on the exchange. But the triggering means that you would be penalized per full-time employee for the 4980 HA penalties. So you get it's the more the harsher penalty if you don't offer coverage to at least 95% of full-time employees. If you do offer coverage to at least 95%, and the plan does the plan offer minimum value, or it's not affordable, or you don't offer it to 100%, then if one employee goes out onto the exchange, you might be subject and gets a premium tax credit, you might be subject to a penalty under 4980 HB, which is the lesser, as indicated here, either $3,000 per full-time employee receiving the premium tax credit, or $2,000 per full-time employee minus the first 30 or 80 in 2015. So why do I set it up like that? So you understand what you have to offer and what the government is looking for when you're going to report at the end of this year or early 2016. How will the IRS know how to assess the penalties I've just gone through, and how to identify individuals who have not been offered health insurance benefits? The only way they're going to know is if the employee reports and the employer reports. And you have to report. The employer has an obligation to report to the IRS and to the employee, and then the employee is going to report when they file their taxes. They're going to report whether they enrolled in health insurance. So, for that reason, the employers have comprehensive reporting requirements starting in 2015, and to show that they've complied or maybe not complied with the employer mandate. So the final regulations for the employer reporting provisions were issued back in 2014, and it applies to employers who are subject to the provisions of the employer shared responsibility provisions. So basically it applies to all applicable large employers. And I want to make it clear that it applies to all applicable ALEs for 2015, even though, as you might have heard or you might know, the penalties are not going to be assessed for employers with 50 to 99 full-time employees. Those employers still, if you fall into that category, have to report for this year. Okay? So the final forms were released in September of 2015, which was relatively recently that we've seen these new forms. And the final forms are what you might have heard, Forms 1094C and 1095C. So who must report? As I've mentioned, applicable large employers. So those employers with at least 50 full-time employees, so employees having an average of at least 30 hours of service per week, including full-time and equivalent employees. They have to report, as well as the applicable large employer member. So if the applicable large employer, the ALE, is made up of members, those members have to report, and the reporting is per member. What is an applicable large employer member? I'm going to go into a little bit of more detail here, dig a little deeper. All persons or employers treated as a single employer under the IRS aggregation rules are treated as a single employer for the purposes of determining the applicable large employer, or ALE. Although ALE status is determined by looking at all the members of the ALE together, liability applies on an ALE member basis. So employer information is required to be filed for each member, except, I'll point out, the members with no employees. So if you have, for example, let's look at an example. Say you have entities A, B, and C. They're part of a controlled group, so they have common ownership. In the prior calendar year, A had no employees, B had 40 full-time employees, and C had 60 full-time employees. C they would all be an applicable large employer because they have an aggregate of 100 full-time employees. However, A does not have to report because it doesn't have any full-time employees for that year. So why must you report? Again, the IRS will use this information to administer the employer shared responsibility provisions and the premium tax credit. To whom do you report? Well, similar to other IRS reporting required of employers, such as W-2 forms and the 1099 forms, the information will be reported to the IRS and the employee. What information needs to be reported? Well, we're going to look at the forms in detail, but you're reporting for all full-time employees, and you're reporting on a month-by-month basis the following. Who did you offer coverage to? The employee, spouse, or dependents? What was the lowest cost of the monthly premium for self-only coverage, providing a minimum value? And what type of coverage did you offer? So we're going to look at the indicator codes that are going to be used in the forms that will be able to report to the government what type of coverage was offered and when. I want to give a little note here about temporary employees because I think there's a little confusion out there. The Affordable Care Act defines employees under the law as either full-time, part-time, variable, or seasonal. There's no definition for temporary employee. There's no exception for temporary employee under the ACA. The IRS basically uses a multi-factor test to identify common law employees. The IRS doesn't look at joint employer status, basically. Under the IRS rules, you're either an employee or you're not. So the focus is on the employer's right to control how, where, and when the worker does the work. Generally, the relationship of the employer generally an employment relationship will be found when the person for whom services are performed has the right to control and direct the individual who performs the services. So if you hire a temporary employee and they're going to be there for an indefinite amount of time, and you know at the time of hire they're going to work for 35 hours a week on average, and you are directing what they do on a daily basis and have the right to control how they perform the work, it's likely that although you might categorize them as a temporary employee, the IRS is going to find that they're your common law employee and you have an obligation to offer health insurance coverage to them. Again, there's no exception under the regulations. There's exceptions for seasonal employees, which is a very clear defined definition. But for temporary employees, there's no exception. So you have to also report on behalf of these temporary employees. Now, that's not to say there's not an agreement between potentially you and your employer, the employer, and some staffing agency as to who's going to take on the burden of providing health insurance and who's going to take on the burden of reporting. And under the IRS regulations, there is a provision that you may take a credit for the offer of coverage by the temporary agency if they charge you a fee that's higher per that employee who takes health insurance coverage. And that's getting into the weeds a little bit. But I just want to make it clear that there's no exception for temporary employees. And lots of my clients are running into this issue, especially in light of the 70%, 95% calculations. Because if you get down to the wire in 2015 and you think, oh, I've offered coverage to all my full-time employees, and you have 100 full-time employees and then 50 temporary employees, so 150 total, and you haven't offered coverage to those 50 temporary employees because you're taking the position that they're not your full-time employees, then you might be in a bind. So if you have questions about that, of course, please let me know. I also want to make a note here about third-party and multi-employer plans. Third-party and multi-employer plans are permitted to facilitate the filing and furnishing of the returns for ALE members. That is, you might be using a third party to help you file these forms, help you, gather the information. If you have an HRIS system or some type of system and some third party is generating the reports, that's fine. That's permitted. But the liability for reporting is not transferred to the third party or the multi-employer plan. It remains with the ALE member who's doing the reporting. Okay, so getting into the forms, there are specific forms that the IRS has put out, which I've included the link here if you want to take a look at those at your convenience, and we're going to go through them. I have them on the slides and a few more slides here. But you're going to become familiar with this terminology, as you would the W-2, the Form 1099. Most people in HR and otherwise, even employees know, okay, I'm getting my W-2 at the end of the year. I'm a 1099 worker. I'm going to get a Form 1099 to file my taxes. Well, these Form 1094C and 1095Cs are going to become commonly used terms in the industry. So the Form 1094C is the transmittal of employer-provided health insurance offer and coverage information returns. So that is the transmittal letter that goes to the EEOC, not letter, but form, excuse me. And then the Form 1095C is the employee statement. So what you're going to be giving to the employee. The 1094C, if you've looked at it, has reporting information regarding the employer's name, address, EIN number, and contact information. You have to report the number of 1095Cs being submitted. And if you are an ALE member, you're going to have to include in that form ALE member information. So if you're part of an aggregated group, if you're providing the authoritative transmittal, so one authoritative transmittal has to go for the applicable large employer, etc. And we're going to look, like I said, in detail at these. Now, the 1095C has requirements that you report regarding the employee, their name, social security number, contact information, the employer name, EIN, and contact information, an offer of coverage, of health insurance coverage by month, and the employee's share of the lowest cost monthly premium for self-only minimum value coverage. And then if applicable, the covered individuals, If there are other covered individuals, that the employee's dependents or the like, then you identify them on the form. And when we go through these, I think you'll understand why at the beginning of the presentation I went through the terminology regarding affordability, minimum value, because these come up on these forms, and if you don't have a solid understanding of what they are, these forms will give you what I like to, a stress headache, because if you don't know what you're looking at or what they're asking for, you're going to be thoroughly confused. So let's look at the 1094C form, which is the transmittal of employer-provided health insurance offer and coverage information returns. As you see here, and I don't have a mechanism where I can highlight, but I'm just going to go down basically the form and point out the information to you. So Part 1 is the applicable large employer member. You see that. That's why I pointed out to you that you're reporting on a member-by-member basis. Now, that if you're not part of a control group, if you know that you're not part of a control group, you're still reporting as the applicable large employer. But I want to point out, I just got disconnected from the presentation. I'm sorry, 1 second, bear with me. Okay, I'm back. You're going to be reporting on behalf of the member. An applicable large employer that's not a member is reporting on behalf of itself. You're going to fill in the name of the ALE, employer identification information, street address, city or town, state, county and zip, name of the person to contact, and the contact telephone number. So don't be surprised if you, after submitting these, get a call from the IRS or have some contact from them. If you're a designated government entity, you fill in lines 9 through 16. Line 17 is reserved. They say it's reserved for future use, so the IRS is holding that place. And you see line 18, you're going to fill in the total number of Form 1095-C submitted with the transmittal. So the 1095-Cs are the ones you're providing to the employees. You're also giving them to the government, and you're going to say, okay, I'm providing 150 1095-Cs are being submitted with this transmittal. And then 19, is this the authoritative transmittal for this ALE member? There's instructions in the form, but if it's the form that's being submitted on behalf of the applicable large employer in the aggregate, then you check yes there. Part 2, you only fill out if you are an ALE member. So if you're an applicable large employer, not a member, you don't fill out Part 2, okay? At least line 20 and 21. Now, certifications of eligibility. This is where we're going to get into a little bit of detail here. The IRS has come up with simplified reporting mechanisms that you can take advantage of. The qualifying offer method, the qualifying offer method transition relief for 2015 only. Section 4960H transition relief, that has to do with non-calendar year plans. And so if you're reporting for non-calendar year plans, obviously you're not going to report for the calendar months that your plan for 2015 wasn't in effect. So, for example, if your plan runs from December 1st, 2015 forward, and we're going to talk about this, one of my slides talks about this in more detail, and the plan was in existence back in 2012 when the regulations were finalized, you can take advantage of the calendar plan year and don't have to report until December, basically for December 2015, that only month, for this year only. And then the 98% offer method is here in the box D, which we're going to go into. This is the second page of 1094-C. This is the ALA member information, and again, you only fill it out if you're an ALE member. Excuse me, I misspoke there. That's for part 4. Part 3, you do fill out if you, for all 12 months, offer minimum essential coverage, full-time employee count for the ALE member. You fill it in there. The total employee count for the ALE member, and then whether you're part of an aggregated group, and Section 4980H transition relief indicator. The forms have a detailed, and the instructions for the form have a detailed discussion of the transition relief indicator codes that would be used there. And Part 4 is the part where you only fill out if you're an ALE member. Okay. So I talked about those alternative reporting methods. The IRS has said in order to simplify reporting, you can use these 2 different methods. Now, you don't have to. The general reporting method, so filling out the forms in its entirety for every employee and for full-time employees and for the transmittal, is acceptable. But they're trying to simplify things by giving you 2 alternatives. They include the qualifying offer method and the 98% offer method. They can only be used if the employer meets certain criteria. And we're going to go through that now. So the alternate reporting method of qualifying offer can be used if the employer certifies that it has provided a qualifying offer to one or more full-time employees, and the qualifying offer must be an offer of minimum essential coverage providing minimum value at employee cost for employee-only coverage that is affordable, and include an offer of at least minimum essential coverage to the employee's spouse and dependents, if any. If the employer can certify a qualifying offer was made to one or more of its employees, then for those employees, the employer completes its returns using the simplified reporting process, which means that on Form 1095-C, the employer will complete the information to identify the employee and the employer and use code 1A. And if you've looked at the instructions for the form, you know that 1A means qualifying offer, and you put that in box 1 for all 12 months. And we'll look at that form in a minute. So you just use code A and you put it for all 12 months, and that just simplifies reporting. So you don't have to put in the employee's share of the lowest cost monthly premium, the applicable sections. It's a way of the IRS giving the employers, I guess, an easier way to do things. Now, for transition, there's a transition rule for 2015. So for 2015 only, full reporting will not be required for employees who do not receive a qualifying offer for all 12 calendar months if the ALE member certifies that it made a qualifying offer to at least 95% of the full-time employees. So this is transition relief only available for 2015. And then finally, the 98% offer transition relief. And you're probably asking yourself, why is the IRS doing this? Well, basically, for the 95% offer, it means that you don't have to report your full-time employee count on a monthly basis. If you recall in the form that we looked at, let me go back so you can see, full-time employee count on a monthly basis, you'd have to report. So if you don't want to count your full-time employees because you know that you can certify that you offered coverage to at least 98% of the employees on whom you report, that you offered coverage that is affordable and it meets the minimum essential coverage and provides minimum value, then you don't have to report the number of full-time employees per month. So again, it's a simplified way of the IRS allowing you to simplify reporting. I don't know if that gives you any comfort in this really complicated field. But at least they're throwing us a bone, I guess. All right, so that's the transmittal form. Now we're going to go into the 1095-C, which is the form that you're giving to employees. Here it is, the 1095-C form. It's the employer-provided health insurance offer and coverage form. I'm going to walk through it. In Part 1, obviously, you put the employee's information in, the name of the employee, the social security number, street address, city, town, state, zip, county, or country and zip, excuse me. The applicable large employer information goes in lines 7 through 13 at the top in Part 1. Part 2 is where things get complicated and where I think most of the questions have been coming in. So in Part 2, as you see, line 14 is the offer of coverage that you've entered. And there are specific codes, and this is the Code 1 series, that you would enter for each calendar month, or, like I talked about, for if you offer qualifying coverage for all 12 months, you can simplify your reporting and put 1A in that all 12 months category. And we're going to go through the codes in 1 second, but line 15 is where you put in the employee share of the lowest cost monthly premium for self-only minimum value coverage. And we're going to go over an example so you can see what I mean. So you'd put in, say, $150 is the employee share of the lowest cost monthly premium for self-only minimum value coverage that was offered to them. So as long as you offer coverage that's affordable, you can identify that coverage here. And then line 16 is the applicable section 4980H safe harbor provisions. So basically you're entering in here what type of coverage was what the employee status during the month was. So we'll go through again in detail as we get to the next slides. Part 3 is where you list the other covered individuals and their information if you have it. Okay, so the Code 1 series. The Code 1 series indicator codes specify the type of coverage, if any, offered to an employee, the employee's spouse, and the employee's dependents. The Code 2 series indicator codes are reported on line 16 to identify the specific situations regarding the employee and enrollment. For example, if the employee was not employed or was not a full-time employee that month, or the employee was enrolled in the minimum essential coverage offer, or the employee was in a limited non-assessment period. What does that mean? That means they were being measured. You might have heard that you can measure variable hour employees. So those that you don't know at the outset of employment are going to work 30 or more hours a week or average that, you can measure them. And if you're reporting because at some point you've determined that they were eligible and gave them coverage, but for, say, January and February they were still being measured, you put in a certain code. Non-calendar year plan transition relief has another code. So all of these things that we've been talking about, you're going to have to know, understand, and then be able to report on. So here's an example to put this all into maybe better focus. Let's have an example. The employee is hired into a regular full-time position on February 15th, 2015. So you know at the outset, you're hiring this employee, regular employee, not a temp. He's in a full-time position, meaning he's working 30 hours a week or more. There's no reason to measure him. You can only measure people who you don't know at the outset of employment are going to work 30 or more hours a week. Okay? So the employee's in a waiting period. Most employer-sponsored plans have waiting periods, right? So he's in a waiting period. It can't exceed 90 calendar days. And the caveat to that is if you have a bona fide orientation period, that can be 30 days. So the waiting period, he's in for a little over 2 months, so until 4/30/15, so April 30th, 2015. The employee and the family are offered by the employer minimum value, minimum essential coverage on May 1st, 2015. The monthly minimum value, minimum essential coverage for self-only contribution is $200, which is affordable for this employee based on the rate of pay safe harbor. We don't know exactly what he makes, but let's assume it's affordable to him. The employee waives coverage effective May 1st, 2015. So he waives coverage initially, but then he enrolls in coverage on July 1st, 2015 because of a qualifying life event, which is his spouse changed employment. So maybe he had to jump on his employer-sponsored plan because he got off his spouse's. And then the employee and coverage was terminated December 15, 2015. So let's look at the boxes here. Line 14. There was no offer of coverage because he wasn't an employee in January and February. He became an employee February 15, 2015. So 1H is entered, which means no offer of coverage for those months. And then he's in a waiting period. So coverage hasn't been offered for March and April. So 1H, no offer of coverage is entered. Then he's offered coverage starting May He could have enrolled, but he didn't, right? And it was minimum value, minimum essential coverage offered to the employee and offered to his spouse and his dependents. So 1E is entered. 1E meaning, and if you need the cheat sheets, I'm happy to send these to you. I don't have them on the slides. These are contained in instructions to Form 1094C and 1095C, the codes, which if you're in HR and you're going to be doing these forms, you're going to become very familiar with. So 1E, minimum essential coverage, providing minimum value offered to the employee and at least minimum essential coverage offered to the dependents and spouse. So that's entered for May, June, July, August, September, October, November, because it was offered, and later we'll see he enrolled. When we go down to line 16, we'll see the changeover where he enrolled in coverage. But for line 14, we show 1E for those May through November that he was offered coverage that met the requirements under the Affordable Care Act. And then the month that he's terminated, which is interesting, and I want to point out, you put in 1H, which is no offer of coverage, even though for a portion of that month he was still employed. But the government has said that month that he terminates, you base it on the month. So for the full month, was he offered coverage? No. So you're going to put in 1H, okay? So then go down to line 15 where you put in the employee share of lowest cost monthly premium. For the first 4 months of the year, he wasn't offered any, so we leave it blank. And then for May, June, July, where he was offered, May through November, let me be more clear, where he was offered the coverage, we're going to put in the lowest cost of monthly premium for self-only coverage, which is affordable to him, okay? And you don't put it in for December. Now, let's look at 16. We're putting in the applicable codes here. So 2A, he's not employed. And if you look at the cheat sheets, which I'll send to you, which everyone's asking for, I see on the comments, 2A specifically says, the IRS has said, employee not employed during the month. So we put in 2A. He wasn't employed during the whole month. He wasn't employed until February. In February, 2D, so employee in a limited non-assessment period. He's in the waiting period. The limited non-assessment period, he's not being measured. He's in the 90-day waiting period, or in this case, it was less than 90 days. Then, in May and June, he didn't elect coverage, but he was offered it. So we're going to put in 2H, the affordability rate of rate of pay safe harbor, to determine affordability. He was offered it. And then when he takes it, 2C means the employee was enrolled in coverage that was offered, 2C. And then when he leaves, in that month that he leaves, it says 2B, which means the employee was not a full-time employee for that whole month, okay? Okay, so I'm reading off the IRS regulations here because I want to make sure you understand 2B at the end there. Enter 2B if enter 2B also if the employee is a full-time employee for the month and whose offer of coverage ended before the last day of the month solely because the employee terminated employee during that month. So it might be counterintuitive here to say employee was not a full-time employee for December because he was half the time employed. But the IRS has said if they terminate during mid-month, you enter 2B, that employee is not a full-time employee. Okay? So this is where the real, complicated reporting obligations that give employers headache comes in. Filling out these forms, this form, putting in all these codes. What do these codes mean? Deciphering them. Deciphering what they mean. So I know it's complicated, and I hope that example gives you some indication of what you need to be doing. As I mentioned, non-calendar year plans. If a plan was in effect in December 2012, the employer is eligible for transition relief. That means the employer You have to report that you're eligible for this transition relief in 1095C line 16. So I'm going to go back. Line 16, there's a code that specifically you enter here if you're a non-calendar plan year and that you were in effect in 2012, you might be entitled to that relief. I have a lot of questions that come up about how you report offers of COBRA coverage. And the IRS specifically has some examples that they've put forth regarding this. But the bottom line is that an offer of COBRA continuation coverage that is made to a former employee due to termination of employment is not reported as an offer of coverage in 1095C unless that employee enrolls in COBRA coverage. So even if you've sent the forms and it's just hanging out there for, they have 60 days, if you've sent the forms, they haven't enrolled for those months that you're waiting, you don't identify it as an offer of coverage in the 1095C unless they enroll. And because you're reporting at the end of the year, you'll know if they enroll, then you indicate that they've enrolled in coverage for those months. So when do you have to report? Statements must be provided to full-time employees by January 31st of 2000, so that's January 31st, 2016, after the end of the year for which the information is being reported. The deadline for reporting to the IRS is February 28th, after the end of the year, or March 31st if the return is filed electronically. And you're reporting on the calendar year basis regardless of your group's plan year or renewal date. You're still reporting on a calendar year basis. So think past 2015 what that means for you. That means that you're going to be reporting, say your plan year starts June 1st. Half the year you're going to be reporting for one plan year, the next half for the next plan year. So keep that in mind as you go forward. Is there an obligation to file electronically? It's only an obligation if you are an applicable large employer that files 250 or more information returns during the calendar year. Then you have to file electronically, otherwise you do not. Okay, a note about small employers with self-insured plans. And I don't know how many of you fall in this category, but so a little known provision of the law requires small employers, those with fewer than 50 full-time employees, that sponsor self-insured group health plans. So if you're self-insured and you're a small employer, you have to report information about employees and their spouse and dependents who enroll in coverage. You have to report it to the IRS, and you have to report it to your employees. And these are different forms, 1095B and 1094B, which I've included the link here for you to access if you are one of those employers. So what are the penalties? You always want to know what happens if you don't do the filing or you don't comply. Well, I'll give you a little bit of solace here. The IRS has said if you make a good faith attempt to fill out the forms but get something wrong because they're so complicated and convoluted and maybe the IRS doesn't even know what they mean, you're not going to get a penalty necessarily as long as you make a good faith basis this first year to comply with the reporting requirements. But if you wholly fail to report or provide the statements to your employees, the penalty for failure to file an information return is generally $250 for each return which a failure occurs, total not to exceed $3 million. So I do note there is a provision, and you can look at these in the forms, that you may obtain an automatic extension of 30 days to complete the forms by filling out a Form 8809 application for extension of time to file the information returns. The IRS has said no signature or explanation is required for the extension, so I'll just put that out there to make you aware. So I know we have lots and lots of questions on the side of the slide. I'm going to scroll up and see if I can answer them for you. Okay, in the 4 minutes that we have remaining, I'll try to get to these. So the first question is, we are a small employer. We have never had more than 47 employees at any one time for our weekly payroll. But at the end of the year, with terminations, we will submit 58 W-2s. Are we still considered a small employer? So that's a good question. It's not based on your W-2 count. It's based on your full-time employee count, and determining whether you're a full-time employee, you look at your average number of employees and full-time employees and full-time employee equivalents for the preceding calendar year. So for 2014 is what we're talking about. You have to look at that and look at how many full-time employees you had on average over the year, as well as add the full-time employee equivalent. So all of your part-time employees' hours have to be added, and there's a specific calculation that you go through. But if at the end of that calculation, which I can provide you more information how to specifically calculate it, but if at the end of that calculation, regardless of how many W-2s, because of, like you said, of the terminations that you might have had, you are under that 50 employee threshold, then you would be considered not an applicable large employer and have no reporting obligation. But since you're such on that cusp, I would invite maybe a further discussion about that. Okay. What if you offer coverage and an employee tries to or gets coverage incorrectly on the marketplace? How does an employer guard against that? Well, that's a great question. You can't necessarily guard against it, but you're not going to be penalized if you offer minimum essential coverage that's affordable, that meets the minimum value to that employee and to substantially all of your full-time employees. So if that employee goes out into the exchange, gets coverage, and the IRS compares your report, which this is why you're reporting, your report that says you offered them that coverage that met the requirements of the Affordable Care Act, and therefore you're not penalized for them getting that premium subsidy. It's all about the offer. It's not about whether the employee takes the coverage or not. I hope that makes sense. You can't necessarily guard against employees from going out. They can shop wherever they want, but you're not going to be penalized for them shopping, right? Because you've offered them coverage. Okay. I will send the codes to Eric, and he can distribute them. What's the difference between 2D and 2I? So the question is asking about, let me go back to the forms here. So 2D here is identified, and we don't have 2I identified, but I'm going to tell you what it is. And the audience member is asking what the difference is between 2I and 2D. So 2I is a non-calendar year transition relief applies to this employee. Enter 2I if non-calendar year transition relief. Basically, that means what I talked about before, the non-calendar plan year. So if you were a plan in effect back in 2012, December of 2012, with a non-calendar plan year, you might be able to take advantage of that transition relief, and that's what the code you enter. 2D is the employee's in a limited non-assessment period. So for any month the employee is in the waiting period, is an initial measurement period. Basically, if they're a variable hour employee and you're measuring them, you can enter 2D. Okay, so there's the difference. And I'm going to take one or two more questions because we're about out of time. So let's see. If coverage goes through the end of the month, even if the employee leaves mid-month, do we put coverage in for the month that they leave or not? So I think I answered this question when we were going through, and this example shows if the employee does leave mid-month, and the code specifically says this, you don't report for that month. So if we look at this example that's on the screen now, 1H is filled in, which means no offer of coverage, and 2B, which means the employee was termed mid-month, and you don't identify the employee share of the lowest cost premium for that month. Okay? The question is, does it matter whether we use 2C or 2G if employees are enrolled? Yes, it does. There's a difference. If the employee is enrolled in coverage, you're entering 2C. If the employee is not enrolled in coverage, but you know you're certifying basically by entering 2G that your coverage meets the the affordability standard using the federal poverty line safe harbor. That's when you enter 2G. But you enter that only if the employee is not enrolled in coverage. Because you're saying, for that example that we talked about before, where the employee goes onto the exchange and you've offered them coverage, they just haven't enrolled, you want the government to know, hey, we've offered them coverage. 2G, it meets the federal poverty line safe harbor rate of pay. We've offered them coverage, they just didn't take it. No, they're not enrolled, but we gave them the option to enroll. So there is a difference. Okay, the final question, do we need to provide this for anyone who has worked for us during 2015 calendar year, even though they may have separated? The answer to that is yes. It's just like a W-2. So even though an employee might have been terminated in June of 2015, you still have an obligation to provide the form for representing the time period that they work for you, so they can file their tax returns and so the IRS knows how much they made. Same thing goes for these forms. And I want to point out that you're only responsible for reporting offers of coverage made to full-time employees. So you really have an obligation, or have to know who your full-time employees are. I really appreciate you all spending the time with me. I hope I answered some questions you have. I will send Eric the cheat sheet that I was talking about. I think he's going to email the presentation to everyone. Thank you so much, and you know where to contact me if you need anything further.
Yeah, thanks for coming on, Teresa. Really enjoyed the presentation. A lot of great stuff. We really did have a ton of questions come in. I'll try and see if I can do something with all of these questions because there are so many. And I think if Teresa were to try to go through all of them, we'd be here for another hour possibly. We've done about 9 webinars since April, and it's been a good year. So we appreciate you guys taking the time to spend another one with us. If you want to check, we'll send you the recording and the slides, but if you want to check out our other webinars, they're all posted on YouTube. I'll definitely include the cheat sheets, the slides, everything in our follow-up email, which hopefully will get out tomorrow to you. So yeah, thanks again, Teresa and Shawe and Rosenthal. On behalf of HRsimple.com, thanks for spending time with us, and we'll see you next year.